Hello and welcome back, guys. So in this particular session, what we will be discussing about is SPR's exam kit question number 2, banana. Okay, so what we are given in the question is, let's read the question first of all properly, and let's plan our answers when you are reading it as well. So background: banana is a parent of a listed group of companies which have a year end 30 June 20x7. Okay, so first thing first, I have noticed the dates already. So this date and this date, did you notice something? So Banana has made a number of acquisitions and disposals of investment during the current financial year, and the directors require advice as to the correct accounting treatment of these acquisitions and disposals. The acquisitions of Grape on 1st Jan 20x7, Banana acquired an 80% equity interest in Grape. The following summary of the Grape's equity at the acquisition date. So this was the equity section. So summary of equity. So share capital 20, return earning 42, other component of equity 8. And this is OCI's item, and then 40, right? 70, right? And then the purchase consideration comprised 10 million of banana share which had a nominal value of $1 each and a market value of 6.8. So cost of investment under it, we'll write shares, which is 10 million into 6.8. So it does not say any share for share exchange or anything of that sort. So it gives us the pure value. Okay, so that's what we should do for goodwill calculation, right? And then additionally, cash of 18 million was due to be paid on 1st Jan 20x9. So that means 1 year, 2 year, after 2 years, right? If the net profit after tax of Grape grew by 5% in each of the 2 years following acquisition. Okay, so net profit has to increase by 5%. The present value of the total consideration at 1st Jan 20x7 was 16 million. Okay, this is also given, so it's easier now. No need to discount or anything. So it was felt that there was a 25% chance of the profit target being met. Okay, so there was only 25% chance. So that means this is the present value, and then we need to also multiply it by 25%, right? In case of deferred consideration, in case of under cost of investment, that's how we normally show it, right? Because in case of contingent consideration, this probability also reflects the uncertainty of this amount being paid, right? Because it's only 25%. So if the chances would have been bigger, then the fair value would have been bigger as well, or the amount that we would recognize would also be bigger. Okay, so at acquisition, the only adjustment required to identifiable net assets of Grape was for land, which had a fair value of 5 million. Land, okay, no depreciation. That means 5 million higher than its carrying amount. So 70 is already here. So 5 added, 75 will be the net assets. And then this is not included within the 70 billion equity of Grape at 1st Jan 20x7. Okay, so it's not included over here. And then goodwill for the consolidated financial statement has been incorrectly calculated as follows. So share consideration has already been accounted for. What about deferred consideration? It does not say anything, right? So it's incorrectly calculated. Okay, so NCI as well, 20% of 70 million. So is it 70 million? Oh, it's using the other technique, net assets method. So what is the group's accounting policy? It does not say anything about that over here, but let's see. So goodwill at acquisition is this incorrectly calculated. The finance director did not take into account the contingent cash, okay, since it was not probable that it would be paid. Additionally, he measured the non-controlling interest using the proportional method of net assets, despite the group having a published policy to measure non-controlling interest at fair value. Okay, so it's a policy to measure at fair value, but it measured at net assets. Okay, so share price of grape at acquisition date was 4.25, and this should be used to value the non-controlling interest. So share price of grape was 4.25. Why is it different over here? Okay, so there this market price could have been for any other date. Okay, so we'll just use that figure whatever the question says. And then so that's the goodwill part, and then let's see what else. So that's for grape, and then there is acquisition and subsequent disposal of strawberry. Okay, so banana had purchased 40% equity interest in strawberry for 18 million a number of years ago, when the fair value of net assets was this million. So 40% interest, that means it's not a subsidiary unless proved otherwise. And then how can that be proved otherwise is if the company has a control over it or not. We need to determine whether the investor has control over the investee or not. So what is the definition of control? Once again, so control is that the investor has power over the investee. Investor has right or is exposed to variable returns from the investee. Investor can use its power to affect the variable returns. Okay, so that's the control thing. And what are the criteria that should be met for like if you were to have a control is that if the holding is less than 50%, but the number of shareholders are numerically large and dispersed, then also it is possible that even though we don't have a 50% holding, you can still count it as a subsidiary, or as it qualifies as you are having a control. Okay, and then after that, the second criteria being, so in case of control, right, the agreement between investor and investee. Okay, that's also important. And then if there are any convertibles, so if there is any share options that is likely to be exercised and which results in higher percentage of holding, then also it is assumed that the investor has a control. Okay, so suppose you have something in share options which is convertible after a few years, and then you are likely to exercise it, that means you have a control. Okay, and then what's the voting rights in the BOD, that also determines the control. Okay, so sometimes there might be only 40% interest. In this case, let's say, like suppose it's 40%, but the company has a right to appoint more than 40% of its shareholders, I mean BODs. Okay, so that means that will give it a control, right? So we need to consolidate it, otherwise we need to use equity accounting. So let's see what has happened over here. So equity interest in strawberry for 18 million a number of years ago, does not specify any date, when the fair value of net assets was 44 million. Okay, since acquisition, banana had the right to appoint one of the 5 directors. So that means 1:5, that means is it 20%. So even though it has a holding of 40%, it should have been able to appoint 2 directors, but has only right to appoint 1 director. That means out of the control criteria, we can tick one out. Okay, so that means the first thing is gone. It cannot appoint majority of the directors. Okay, so that thing is out of the way. The investment has always been equity accounted for in the consolidated financial statement of Banana. So equity accounted, that means it's associate, so otherwise we would have consolidated it. So Banana disposed of 75% of its 40% investment. Okay, so 75% of 40. Okay, on 1st October 20x6. Okay, so first 20x6, what is our year end? Does it say anything year end? So let's see the year end. 30th June, right? 30th June. So that means 30th June on October 20x6. So it's before our thingy. So it's 9 months, I guess. 9 months earlier than the reporting date, I guess. Let's see, we'll figure that thing out. But it's a mid-year kind of thing. Just remember that. And then for this much, when the fair value of the net assets were this much. So this figure, this net assets minus this is our post-acquisition profit. Our cost is also given. And then is there anything else that we need to subtract? At the date, Banana lost its right to appoint one director to the board. Okay, so it's lost. Okay, the fair value of the remaining 10% equity interest was 4.5 million, so it's 10% equity interest. That means now it has become trade investment, right? So which is as per IFRS 9. So we'll have to apply IFRS 9 after that. So as per IFRS 9, what are we accounting for? Assets, financial assets, and then it's equity as well, right? So in case of equity, what we normally do is that it can be classified as, in case of equity, it can be classified as fair value through OCI or profit or loss. Okay, and then after that, in this case, so if it is to be classified as fair value through OCI, it should be a irrevocable choice that the company cannot, once it is initially recorded, it cannot be, if they have chosen OCI, then it cannot be reversed. Okay, so if they have chosen fair value through profit or loss, then also that's all gains and losses will be charged to SOPL, whereas in case of OCI, all gains and losses charged to SOPL, OCI. Okay, in subsequent recognition. So okay, that being said, 10% disposal was this, but only 4 million at 30th June 20x9. Okay, disposal date was different, so 0.5 million. So they disposed it at the same date, right? Nope. So this is our year end. Okay, so the OCI. Okay, so 0.5 billion is loss. So Banana has recorded a loss in reserves of 14 million, calculated as the difference between the price paid of 18 million and the fair value of 4 million at the reporting date. Why did they do that? Loss of 14 million. Banana has stated that this should be wrong, I guess. So 14 million, that's not possible. That's not how you account for it. Let's see. Banana has stated that they have no intention to sell their remaining shares in Strawberry and wish to classify the remaining 10% as fair value through OCI in accordance with IFRS 9. Okay, so it says clearly fair value through OCI, IFRS 9 makes it easy. We don't have to basically make an assumptions and then answer it, and that's always good. Acquisition of Melon. On 30th June 20x7, Banana acquired all shares of Melon, an entity which operates in biotech. So on the last date, okay, biotech industry. Melon was only recently formed and its only asset consists of license to carry out research activities. Melon has no employees as research activities were outsourced to other companies. No employees. The activities are still at very early stage and it is not clear that any definitive product would result from the activities. A management company provides personnel for Melon to supply supervisory activities and administrative functions. Banana believes that Melon does not constitute a business in accordance with IFRS 3 business combination since it does not have employees or nor carries out any of its processes. Banana intends to employ its own staff to operate Melon rather than to continue to use the service of management company. The directors of Banana therefore believe that Melon should be treated as an asset acquisition but are uncertain as to whether the International Accounting Standards Board exposure draft definition of business and accounting for previously held interest e.g. 2016 one would revise this conclusion. So we need to talk about exposure draft as well, okay? So in case of Melon, right? So as per IFRS 3, business is basically defined as an integrated set of activities and assets, right? So that's our basic definition. So we'll basically give an argument for that and then draw up a conclusion, okay? If it is asked for or whatever the question will be asking. So let's look at this. So acquisition of bonds. So on July 20x5, Banana acquired 10 million 5% bonds at par with interest being due at 30th June each year. Bonds are repayable at a substantial premium so that the effective rate of the interest was 7%, okay, premium. Banana intends to hold the bonds to collect contractual cash flow arising from the bond and measure them at amortized cost. So that means it plans to hold it till its maturity. So its business model test is and then contractual cash flow is very important to determine whether to classify it as amortized cost or as OCI or fair value through profit or loss, okay? Because if the business model is to hold it till maturity, and if any other better opportunity with higher returns appear, then if it is to sell, then we classify it through fair value through OCI, otherwise amortized cost, okay? So we might put that in our answer as well. So on July 20x6, Banana sold the bonds to third party for 8 million. The fair value of the bond was 10.5 million at that date. Banana has the right to repurchase the bonds on 1st July 20x8 for 8.8 million and is likely that this option will be exercised. Okay, so after 2 years it can purchase it, okay? The party is obliged to return the coupon interest to Banana. Okay, so that means its coupon interest is also obliged to pay additional cash to Banana should bonds value rise. Interest to Banana and to pay additional cash to Banana. Banana will also compensate the third party for any devaluation of the bonds. Okay, interesting. So what we are required is that draft an explanatory note to the directors of Banana discussing the following: how goodwill should be calculated on acquisition of Grape, and so the accounting entry which is required to amend the financial director's error. Okay, the goodwill as there has been error, and then what are the accounting entries. So why equity accounting was the appropriate method for Strawberry in consolidated financial statement up to the date of disposal, showing the carrying amount of investment in Strawberry just prior to disposal. Why equity accounting was appropriate treatment. Okay, so we need to talk about equity accounting as well. And then gain or loss on disposal of subsidy Strawberry should also be recorded in financial statement. How the investment in Strawberry should be accounted for after the part disposal. Okay, so after part disposal, of course IFRS 9, but we will still need to show some profit, gain or loss as well, right? So in B, what we are required is, I think it's about Melon, whether the directors are correct to treat Melon as an assets acquisition and whether the IASB's proposed amendments to definition of business would revise your conclusions. And then C is about derecognition requirements of IFRS 9. Financial instruments should be applied to the sale of bond, including calculations to show the impact on consolidated financial statement for the year ended 30 June 20x7. So without wasting any time, so let's do the first number question. Explanatory note to directors. So A number, note, directors of banana. Bold it, and then after that one number, right? How goodwill should have been calculated on acquisition of grape. So let's solve that thing first of all. So it has calculated goodwill this way, but should be calculated. So let's use our spreadsheet. Okay, calculation of goodwill. Bold cost. There has been shares has been given, and then what else? Deferred consideration. Contingent. It's not deferred. And then fair value of NCI, right? And then after that, less net assets at acquisition, right? So goodwill. So what's our cost? And shares, how many shares did we issue? 10 million at a price of 6.8, right? So 10 million 6.8, so 10 into 6.8, so 68. And then consideration is 16, and the present value is 16. And then okay, so it was 18 million after 2 years. Its present value is 16 million, and then 25% chance. That means 16 into 25, right? 16 into 25%. And then fair value of NCI. How much is left? So how much shares did we acquire? 80%, right? Out of 20 million. So 80% out of 20. So 80 out of 20. 80% into 20, right? So 16 has been acquired. That means remaining is 4, right? and then I'm missing something over here. 4 into what's the fair value? So it's given over here, okay, 4.25, 4.25, 4.25, 17. Okay, let's sum it up. What about net assets? $70. Any revaluation? Yes, there is, I guess, land which has not been included in 70. Okay, so 75, right? So since it is land, so minus, there would not be any excess depreciation as well. So the goodwill would have been 14, right? Anything else that I'm missing? So it has calculated 12, whereas we have calculated 14, right? Okay. So our calculation part has been done. So calculation, how should have been calculated? So the accounting entry that is required to amend that director's error. Okay, we will talk about that as well. But firstly, what we need to do is that let's explain the calculation procedures of goodwill. Goodwill, right? Goodwill. Goodwill. So what does the question say? How goodwill should have been calculated? Okay. As per IFRS 3 business combination, goodwill is calculated by calculated by or goodwill is the difference differential amount paid in excess of the entity's net assets. Net assets. Right. So why am I doing a bold thing in this? So that's done, and then cost of investment. Should I write that? The standard pro forma is as follows. Cost of investment x fair value of NCI one x, and then after that subtotal, and then another x, then after that less net assets at acquisition. Total, right? Okay, let's done. For that, let's explain our thing. So what has this particular thing done mistake? So the question has made a mistake. The finance director has made a mistake when calculating it. So share consideration. The finance director has calculated the cost of investment incorrectly, as it has only included shares so an adjustment to cost of investment for the contingent consideration should be made. Right. Contingent consideration is the present value is discounted to present value, and is multiplied by probability to reflect the likelihood. So in this case, $4 million, $16 million into into 25%, right? 25% discounted cash flow should also be included in cost of investment. Corresponding liability of same amount is also recognized in financial statement along with subsequent measurement, because there will be a finance cost associated with it as well, right? So we need to account for that as well. That being said, what else did the finance director make mistake? So fair value of NCI as well, right? The director has measured did not take into consideration using proportional method. Measured fair value, or what I could say is that has measured non-controlling interest. What should I say? Fair value. Controlling interest using net proportion method, which is against the company's policy, which is against the group policy. Standards permit however the standards permit both the method. So correct fair value of NCI would be 17 million. What is 17 million? Which is basically 20 million into 20 into 4.25, right? 20% off into 20 into 4.25. Anything else? Net assets as well. It has, what has it done? 70, right? So while calculating net assets, the carrying amount does not include the fair value increase in land of $5 million. So the correct figure is 75 million. Okay, so where did this thing go? Where did my cursor go? So what I'll do is that I'll just copy this whole thing down and then copy. Okay. Contingent consideration is done. Okay, so B number. Do we need to explain anything else? Let's see the question. So how should have been calculated? And so the accounting entry, okay. To amend the financial director's error. So what should be the accounting entry? So our goodwill is 14. What has this particular guy done is 12, right? So what we need to do is that we need to increase the goodwill by 2 million, right? So let's do that first of all. Goodwill million. It's done, and then contingent consideration. That also should be there, right? And then land as well. So it has not accounted for land. So land being 5 million. So 7 million credit. Contingent consideration. $4 million. And what else? What else? 14 NCI. What's our calculation? 17, that means 3 million over there. $3 million, right? That's it, I guess. So question number B. So why equity accounting was appropriate for Strawberry in consolidated financial statement up to the date of disposal, showing the carrying amount of investment in associate just prior to disposal. 4 marks. That means equity accounting. Equity accounting. Why was it suitable? For B. As per IS 28, investment in associates and joint ventures while accounting for associates and JV allows for equity accounting, right? The accounting because it has significant influence. So if an entity owns more than 20%, more than 20 to 50, let's write that thing down as well. 50%, it is considered that the entity has significant influence, right? Unless proven otherwise. The existence of significant influence is evidenced by its representation on the board. In case of Strawberry, can appoint one directors to the board board and then a contractual agreement between investors is not clear and neither does it talks about uh, numerically large and dispersed group of investors, so can be concluded that banana only has significant influence but not control. Thus, it can be classified as associate and be equity accounted. Okay, and then after that, so let's talk about equity accounting. Equity accounting is a method of accounting in which investment is recorded at cost, adjusted for share of post acquisition profit, adjusted for post acquisition net assets. Share of profit or loss is divided or loss and OCI is divided as per is holding. And if the associate has sold any inventory parent, then PURP is also subtracted. So let's look at our question. What does it say? So our cost is 18 million, right? So what will be our investment in associate? Investment in associate, cost of investment, cost. Cost is how much is it? So cost is 18 million, right? 18 million. Dollar 18 million. And then after that, share of profit. No, it's net assets, I guess, over here. Net assets will be much better. So fair value of net assets was 44 million, and then later on it was 50, right? So 50 minus 44, 6. No. We need to do something else as well. So 40% into P minus 44. Right? Because our holding percentage is only this much. So there will be dollar. How much will it be? So 640. So that means 6 and then is equals to 6 into 0.4. Shit, man, what is our 2.4? 2.4 million. No PURP, no nothing else. So this will be our total 20.4 million. 0.4 million. Investment in associate, SOFP. Hold it, and that's pretty much it. Associates, this is not P, this is 2. Shit, man. Okay, and then we will do the third part. Haven't did we miss anything? Let's see again. So equity accounting method and then show the carrying amount as well. So 4 marks has been done, so no need to write more than this. So 3 number, right? So I guess it's been a bit long, so what we'll do is that this will be the part A and then next part will be in the other part. Okay, so that's it.